All right, so let's look at some applications that we frequently run into in time value of money and business opportunities. Jim's selling his business, and Arpit says, I got $60,000, I'll buy it. Betty also wants to buy the business. She doesn't have a lot of cash laying around. She makes an offer of $12,000 today, plus a promise to pay $10,000 a year for 7 years. If she defaults on the loan, Jim gets the business back, so he thinks there's adequate collateral there, and that could justify an interest rate or a discount rate of 15% for the promissory note that Betty's going to sign, where she's going to agree to pay him $12,000 a year for 7 years. Betty has also demanded, or Jim's also demanded Betty pay him $25,000 at the end of the 7 years, and that's just an aggravation payment. And Betty says, okay, I can do that too. What's the total present value of Betty's offer today? And then we can compare that to Arpit's. Okay, well, it's in a couple of pieces. One is the money in the future. All right, we can render that into present value given the information now, and then add that to the cash down payment and come up with a total present value of her payments, and then compare that to Arpit's. Okay, so if I take the present value of her payments, add that to the cash now payments, then what I'll have is the total value of the offer. Just pin that. All right, so this is what Betty is offering. And I can compare that to what Arpit is offering because that's pretty simple. Arpit is offering $60,000 today. All right, so what Betty's offering is $10,000 a year out of her pocket every year for 7 years. And she's also offering $25,000 out of her pocket at the end of the 7th year. And Jim says, okay, I'm going to discount that at a 15% rate. So what that'll come out to is $51,000 and change. All right, so if we add the $12,000 cash that she's offering to the series of cash flows that are worth $51,000 today, that means her offer is about $63,000 in today's dollars. If you compare that to what Arpit is offering, well, that would be less. So what it all boils down to is at 15% interest, Arpit's offer isn't near as good as Betty's. Now, if we were to discount this by 20%, Arpit looks better. If we're going to discount it by 10%, Betty's looking dang good. Okay, but Jim has already said 15% is his fair interest rate there. And so we can see at that rate, he ought to take Betty's offer. Those of you that says, no, at 60,000, he could have more. He won't have more. He won't earn as much money as he could from Betty's offer. At 15% interest, Arpit's offer can't match the amount of money he could get by doing Betty's offer. So Betty's total offer, which comes out to roughly, what, 12,000 plus 70,000 is 82,000 plus 25,000, $107,000 total, all right, is only worth $63,000 in today's dollars, but that's more than the $60,000 Arpit is offering. So he ought to take Betty's offer. Let's go to another example. This is LaPierre. He has a choice between a lump sum payment of $50,000 a day, yay, or an annuity of $12,000 per year for 6 years. His opportunity cost of money or his required rate of return is 10%, which is best based on financial theory. The one with the highest present value is the one that's best. All right, so the lump sum today has a present value of $50,000. Okay, so I know what the present value of $50,000 today is. The present value of $50,000 today is $50,000. The annuity payment would be a grand total of 6 payments of $12,000 each, discounted at 10%. I'll tell you what I'll do. $10 interest, 6 payments. Each payment's $12,000. No other payments beyond that. The OK button. And the annuity payments are worth $52,263. They would be a better deal. We can demonstrate that by setting up one of these amortization tables. 1, 2, 3, 4, 5, 6. If I began with $52,263, which is the present value of that, the interest during the year would be it would earn 12% interest over the course of the year. And I'm going to lose the pennies. And the withdrawal you take out $12,000 at the end of the year, and the ending value, you'd have $45,489. Okay, so if you started the next year with $45,489, earned $4,549 interest, and took out another $12,000, you'd have $38,000. If I do that the next year, the next year, the next year, and the final year, I would end up having withdrawn $12,000 a year for 6 years, all right, by starting with $52,263. If I'd only started with $50,000, I wouldn't have enough money to withdraw $12,000 a year for the entire 6-year period. I'd be able to withdraw roughly $60,000 for the first 5 years, and then in the final year, I'd have almost $8,000. So that's why when we say the present value of this is $52,263, it means that regardless of whether I got $12,000 a year for 6 years or $52,263 a year today, $12,000 a year for 6 years is the equivalent of $52,263 today.